what do people want in LP and what makes a great LP? And one of the key attributes is permanent capital. So we raised it's really an evergreen structure. We created it, it's synthetic, it's a complicated LLC, but we have the ability to take proceeds, right, when we get money back from our funds and use it to make future capital calls or other GPs. And that's just an entirely different structure than what the other vehicles use. And we do that because our GPs want us to have money when they need it. And that's our way of doing it.
Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay Ventures. On this podcast, I interview innovators about their strategies, industries, and decisions. On this week's episode, I chat with Beezer Clarkson of Sapphire Partners. Sapphire Partners invest in early-stage venture capital funds, and Beezer leads their investment team, focusing on both domestic and international funds. Now, Beezer's a star, and I've known her for a long time. She's worked at a variety of marquee firms ranging from Wall Street to venture funds. In addition to leading Sapphire Partners, Beezer also launched OpenLP, a platform that helps foster great understanding between entrepreneurs, GPs, and LPs across the venture ecosystem. So I recommend you check that out. There's a lot of helpful information in this conversation, and if anyone is interested in raising capital from institutional LPs, this is definitely a worthwhile listen. Enjoy. This episode is brought to you by Reshield. Reshield is part of the FounderShield family of insurance brokerage companies. It's a tech-enabled insurance brokerage focused on real estate. If you're interested in learning more, visit reshield.co. Welcome, Beezer. Thanks for being here.
Oh, thank you for having me.
All right. So the way I usually run this is instead of asking you to do your background, I do it for you. With the idea, I might brag a little bit more than you would be willing to otherwise. So if that's okay, I'm going to start and introduce you.
You're the best. Thank you.
Great. I'll save you the awkwardness. Here we go. Today we have Beezer Clarkson of Sapphire Partners on the show. She's a partner at Sapphire Partners, which is a division of Sapphire Ventures. I think I got that right. One of the preeminent Silicon Valley firms. Sapphire both invests directly in companies and invests in venture funds as a limited partner. And that's the side of the house Beezer is on. They're a big firm. They run about $7 billion of capital. And they're invested directly in about 120 companies, 20 of which have already gone public. 40 have been acquired. It's an incredible stat. Through Sapphire, Beezer has been involved with launching OpenLP, a website that helps educate VCs on LP perspectives. So if you're a VC and you're listening to this, worth checking out. Before Sapphire, Beezer had held a variety of investment roles at firms like DFJ, which is where we first met, and before that at the Omidyar Network. She got her professional training at Morgan Stanley, Towers Perrin, Hewlett Packard, and she has way too many logos to go through at this point. That's a hell of a resume, no doubt. What did I miss? Anything we should include, Beezer?
So the only thing that's not really, you don't notice on my resume because it literally was about a 9-month job, was when I came out of business school in 2000, I joined what would now be called a micro fund, but at the time was a major fund. It was a $40 million pre-seed seed fund in the meatpacking district in New York, which unfortunately did not survive the 2001 train wreck that took out most of tech.
What firm was that?
It was called Launch Center 39. It was sort of endemic of the era, but it was cool because it was like the first sort of VC, and also we had an incubator, and I got to do both. And one of the founding partners was Albert Wenger, who's now with Union Square. So,
right.
Yes, my first job in VC was this micro fund accelerator. So now it's very hip, but back then it was a big fund at 40 million.
Right.
Yeah.
The world's very different in New York now than it was back then.
Yes. Oh my goodness. I mean, we can talk about that if we want, but it is wildly different, which is in all good ways, right?
So let's start off though with just baselining for everybody, giving them a little color on Sapphire. Would you mind just giving us the high-level overview on the firm?
Sure.
I've already covered some of the basic stats, but more how you guys do what you do and how you operate.
Sure. So as you said, I represent Sapphire Partners, which is the LP arm. We have actually 3 different investing activities on the platform, and they're all managed by separate pools of capital, separate teams. We love each other, and we like to talk to each other, but we don't commingle the activities. Some folks do, and we don't. And so we can talk about the LP side, so I'll put that aside for now. But the large growth fund that you were talking about, all those logos that you see on the website, all the discussion of direct companies that you ever hear associated with Sapphire Ventures, that's all the direct team. And they invest at, I would say, post-product market fit is the best way to think about it. So sometimes that can be as early as A, but usually more B+. And I'm going to brag on their behalf. They're amazing. Like you read the roster of their investments. It's just really impressive what they've been able to do. And then we have a newer fund, which is actually the Series A fund on the platform, and it's called Sapphire Sport. And that was launched 2 years ago now. Sorry, the pandemic makes timeframes just really wonky in my head. And they focus, again, at the early stage, they're direct, and they focus at the intersection of media, technology, and sport, which when they launched this, started thinking about 3 years ago, was much more nascent. And now it's, in the midst of all discussions. So it's been really fun watching them do that. And that's a newer fund, and it's smaller. They're on fund 1. They're currently investing, but all the information's on our website, so you can check out each of the strategies.
So between those different divisions, how is the capital split? $7 billion is a lot to run.
Yes.
I'm sure not all of that's actively being deployed at the moment. So how much is being deployed and how it's kind of divided across the 3 divisions?
So you can go so we're registered with the SEC, so I have to caveat everything with the RIA voice, but the sport fundraise, I want to say it was like 110 million-ish, and that's out there. And then the growth fund's deploying a $1.5-ish billion vehicle. Honestly, I can't keep up. So what you're seeing on the website is
it's a large vehicle.
view. It's a large vehicle. And what you're seeing, and they also have, they have the ability to write up to $75 or $100 million checks, so they can really run with their companies.
So they're doing more Series C and D. I mean, you can't move that kind of capital in A round.
No, they tend to come in a little bit later as post product market fit, and you can do. One of the things that's changed over time, and they've grown with it, is that in the beginning, when they did their first growth fund in 2011-ish, when people raised growth rounds, there wasn't a lot of additional rounds, right? You raised a growth round and then you went public or got acquired. But now, when you look at, we don't have a stay private forever narrative as prevalently in the market, but there's still a significant number of rounds that go and a lot of larger dollars. So they follow on and they support their companies. So the initial check might not be 75 million, but you can certainly move that into a company over time.
That's fantastic.
We see it in the market all the time.
That's fantastic.
And then on the LP side of the house, our fund is structured very differently. So both the sport and the growth fund, the Sapphire Ventures Fund, are structured as traditional venture funds. We're structured very differently because as an LP, we came to life in 2012. And the context is we had a chance to think through, well, what do people want in LP and what makes a great LP? And one of the key attributes is permanent capital. So we raised it's really an evergreen structure. We created it. It's synthetic. It's a complicated LLC, but we have the ability to take proceeds, right, when we get money back from our funds and use it to make future capital calls of our other GPs. And that's just an entirely different structure than what the other vehicles use. And we do that because our GPs want us to have money when they need it. And that's our way of doing it, right?
Oh, we're going to have to talk about this. We're going to have to pause right there. So who are the LP? So for everyone who's listening, when you hear the LP, it's limited partner, and those are the investors in venture funds in this context. But LPs who are fund of funds also have their own LPs. So who's behind you guys?
So we're just a different beast, and we love it, and we're unusual, and we've been unusual from day one. And
fascinating.
Different is better than better. So we have a single source of capital for the LP side of the house.
Okay.
And we origined out of money from SAP, the large enterprise software company based in Germany. And they are a fantastic LP because they understood that building our LP vehicle would take significant amounts of money, and it takes a significant amount of time, right? And they've backstopped that. But now, since we can roll the money forward, the idea is to really be a self-supporting, sustaining vehicle because as we make our proceeds, we can use that to meet our future needs. So they've launched it, but the idea is that we'll just become our own source.
Okay, so let's just bring this down to reality. So let's say you're a super wealthy person who's going to fund a fund of funds.
Yes.
That is an LP in other funds. Okay,
yes.
Got all that. If the money always gets recycled, when does your family get it back?
Well,
how does this work?
You make more.
Okay, good answer.
The simple answer is we do have a high recycling need,
right.
But that doesn't mean to say you have to use all of it. Like as long as you meet the needs of what also is true about our platform is that we're very consistent in how much we deploy per year. So we don't think of it as people always ask, what's your fund size? And we just don't think that way because it's not how we're structured. We deploy about 125 million in commitments per year. Again, this is the LP side.
Right.
And if it flexes up or down in a given year, it doesn't matter. It's a number to shoot for. What you're not going to do is 0 1 year and be like, oh, the market's crazy, we're going to sit it out. and then try to do 500 million the next year. Like that will mess things up. But if you're consistent in how you're doing it, you can actually then plan for the future. And we do work with a carry structure. So you can, like, the LPs will get fee and carry. And that's part of our structure. Whereas an endowment and foundations, they have different structures because they don't work on a fee and carry basis.
Right.
And we chose that purposefully because also some fund of funds don't work on fee and carry. They get points for the dollars under management. So if they raise $1 billion vehicle, they'll get paid whatever the basis points is on that, kind of regardless of performance. But if their performance is terrible, obviously they can't raise in the future, but it's a different way of doing it. And we pick fee and carry because we live and die by the success of what we do, and we live and die by the success of our GPs, and we just want it to be aligned. Like we're all in on venture. That's all we do. We focus on it. And when we decided when we launched the LP arm we were just going to all in, baby.
That's great. But you guys are budgeting inflows based on fund cycles and outflows based on how much capital you have to make that conveyor belt.
So we do a lot of math. And also it's why in the beginning, for anyone who wants to start an evergreen LP base, you do need to have commitments for a significant amount of money. And it's not my place to share, but we have backstops. So if things take a little while longer, and you can do modeling, usually if you're a GP and you're wondering when you're going to get most of your money back, typically it's between years 8 and 10. Now, when companies want to stay private longer, that pushes the curve out, as one can imagine, which we can talk about whether or not that's actually healthy for the ecosystem. Because PS, the employees of companies that are waiting on their options to mean something don't get as much. So there's some downdrafts to that. But you can model it out, and assuming performance, you see when things are coming back. So you do need, and I say this to people launching their new fund of funds, you really need to be able to see 3 or 4 fund cycles down the road for each of your GPs. So when we went to structure our business, without sharing too much of the inner workings, like we were very conscious that it takes a lot of money to get this going.
Yeah, it's fascinating because the risk in that for folks listening, to me, is the varying time to exit for companies. And we're going to talk about that, I'm sure, in this conversation a little bit more. But I want to talk about in the context of this. Just in the 3-4 years ago, the liquidity in the market, there's kind of no end in sight. There's a lot of companies sitting, post-unicorn status with no way out.
Yep.
And the SPAC boom was not just about SPACs. I think it was about unclogging the back end of the funnel.
Sure.
And so now we've got hopefully a more reasonable time frame. But I can imagine this is really hard to plan, but I guess works if your benefactor is willing to write more checks if you guys get stuck.
Correct. You need to, how do I say it? You want to lean forward, but still make sure you're thinking through all the different permutations of what things aren't going as well as we thought it might. What else do we do? So we launched with that in mind. So we were mindful in the beginning. The other thing is, from the LP perspective, you have to take a very long-term view. It is extraordinarily unlikely you're going to see any money back in any meaningful way from a fund before it's 8 or 9 years old. And if you don't plan for that, it's historic. You can look at it. Now, what we're noticing, just to throw an interesting curveball out, is we have crypto has been producing much faster. And I don't know if that's just a blip because of this recent crypto market that we're in, but there's been you can see it everywhere in the market. And this isn't just Coinbase. You can see it in the tokens. You can see it in different areas, that there's been a lot of liquidity generated. I would call it more in a 4 to 5 year time frame. And that's very crypto specific. And who knows if that's going to repeat beyond my powers of knowledge, right?
Right. That doesn't surprise me because I think everyone's betting there on long-term prospects. We did Coinbase's Series A.
Congratulations.
Thank you.
You can speak more about how crypto is working.
No, but you're always betting on future prospects, and the crypto companies very often when they make money are in the flow of the capital. And so it's really easy to have a really substantial revenue model because transactions, as most people know, is one of the best revenue models out there on the web. So, all right, I want to take a step back though. So Sapphire is huge. You've got a lot of money under management. You've got a lot of companies. You have a lot of partners too. How many partners are on the LP side alone?
When you buy partners, do you mean people on the team, or do you mean investments that we've made?
People on the team.
Oh, let's
do both.
We're a tight team of about 6. We're hiring someone who is supposed to let me know tomorrow if they're going to take the offer. So everyone cross your fingers for me.
If you're listening, take the job. Beezer's great.
We'll look on the listener list, see if he's there.
There you go.
But we keep the team tight. For multiple reasons. We like being a small, cohesive team, so it works for us. The growth team has gotten, you can look on the website and see everybody's names and faces. The growth team has grown. I think I was person number 11 to join Sapphire in 2012. And I think we're going to be 100 people in the next 12-ish months. It's hard to judge because and a lot of the growth is on the growth team because as their fund sizes have grown, they've grown more people. We have a very robust, we call it portfolio growth, but think of it as value add with a lot of thought leadership, talent, marketing, business development connections. That team has grown significantly over the last 8 years. We have a number of people doing talent. As I said, business development, marketing. We also have the firm operations have to flex with you. Like any company, you don't grow what you do without the infrastructure that goes with it. So we have a lot more people now in key roles like heads of people and finance and all those things.
That's fascinating. You don't hear that with a lot of the financial institutions having the full company mid-management layer.
Well, I would say I think this is one of the benefits. I know I'm biased, so I'll just own that, of being both an LP and a GP is that when you're like, well, if we're talking to our GPs and saying this is best practice and we don't do it ourselves, like bad on us. That's crazy. Right. So it does help, right? Because you know that. And we also, on the direct side, invest in these amazing portfolio companies and you see how thoughtful they are in operating. And if you don't learn from that, again, bad on you, right?
Yeah. All the information's there. Mm-hmm. So how many funds are you guys invested on the LP side? So you've got 6 people on the team. And how many funds do you support?
It's an excellent question. So if the LP answer is actually a bit more about who your core relationships are, because and you think of it as a firm, like Interplay. Like if we were an LP in Interplay and you did 4 funds, I wouldn't think of it as, if you ask me how many funds, I'd be like 4.
Oh, right. Let's talk about the
But it's really a relationship, right?
Yeah, right.
And then you might have an opportunity fund and a life science fund. So like these things, so I honestly don't know how many funds we have. I've lost
count. Funds, entities, brands, logos.
We do run LP have portfolio constructions just the same way GPs do. So we like to run a fairly concentrated world. So I'd say we have, Baker's dozen of core US relationships. Okay. And I should give a little context. We do about 70% of our commitments on a dollar basis into US managers. Okay. And then about, call it 20 to 25% into European managers. And then the rest is in Israel. And these are all early stage, which we define as Series A and some seed. And we sometimes flex, like in Europe, we started out with more seed, which we can talk about if that's interesting. And the same thing in Israel, but predominantly in the US, we're focused on the Series A and are exploring seed more, I should say. Now, but that also so in Europe, we have another handful of core managers. So we want to make sure that we have the right size team for what we're doing, but you also, from a portfolio construction standpoint, want to be mindful of all that because it plays together.
What's the profile of a fund that you guys invest in? So for folks listening who are thinking about coming to Sapphire Partners for their next fund, what's the number of partners or what makes something a fit? And it's got to be more than Series A.
Oh, correct. Yeah. So I answer this question in a way that I hope is helpful because we don't have we've definitely seen what best practices look like historically, but that doesn't mean to say that's what it's going to look like in the future. And I think it's really important to be open to that. Otherwise, you'll miss things. So instead, we think about it as the return potential of a vehicle. So for Series A, we underwrite them to a 3x net, meaning when we look at the collective, what they're investing in, who they are, their portfolio construction, how they're doing all their stuff, do we think that can produce a 3x net? And it's easier if there's historical numbers to look at, but we have backed net new funds to the world. And then it's harder because you can't rely on past history to tell. And then for seed, we underwrite to a 5x net. And just to throw something funky out, I'm now hearing LPs ask about 10x net for the very smaller funds, because I got to tell you, the performance is there. In this market, if you had a piece of, Coinbase in a $10 million fund and you had a significant enough piece, like that could be it. Yeah, we have funds we have funds that have double-digit DPI and multiple double-digit TVPI, which again, 18 months ago was less true, but in this market has just been, for certain areas, on fire. Not for all areas, but certain ones.
So for folks listening, it's a good educational opportunity. Will you explain DPI and TVPI?
Sure. So the simplest way I think about DPI is that the money back. So if I invest $10 in Interplay, at the end of everything, net of every cost, every tax, everything, do I make $3 back on my $1 or $5 or $10, or did I make $1.50? That's DPI. because you have to net back the management fees and all these things, which it ends up being not that hard math, but you have a lot of line items. And TVPI, think of it as the numbers on paper. So your companies are still, some of your private companies can still be included. So let's say you have a position in, what's a big company that hasn't gone public yet? I don't know, pick your favorite. What's your favorite?
Course Hero, Warby Parker's a couple we're in
okay.
that haven't gone public yet.
So you will have value of that. It hasn't matriculated as money back into your pocket or my pocket or wherever your LPs are. But on paper, you might be, you show the growth, and that's TVPI. It's total value to paid in capital, but just think of it as your paper value.
Right. So not entirely realized.
Correct. And so there's risk in there. I mean, heaven forbid the markets go significantly sideways for a long period of time. It could evaporate. Which gets into conversations that we end up having with our managers. I actually had one this morning with somebody who has a piece of a very significant unicorn. It was, well, do I sell 25% into the next private round? Because I can 1x my fund on it. And you're like,
It's hard decisions.
Hard decisions. And there's an argument for doing it.
What's your general advice? We faced that decision before for a newish fund. Take the fund off the table, right?
Yeah.
Let the rest ride.
I would say yes. That is the common wisdom, which is if it's maybe a max of 30% of your position, if you can return your whole fund. And again, this usually presumes, we usually end up having this conversation with earlier investors, like on the cap table, because you also are less able, not that any GP can control when a company goes public or things like that, but you're more removed from the decision making. You might not have as much information rights. So you want to make sure that you take some of that risk, but also you'd be sort of sad if you sold everything. Maybe not, because who knows, maybe it's a tough call. So people have been doing that as a way of managing the two options.
I'm fascinated by something you said just a few minutes ago. You said you'll underwrite a Series A fund to a 3X, even if they don't have any historical track record.
Oh, no, not that. If they're net new. So we have not, we're asking ourselves these questions, like should we and could we, is backing somebody that's never managed institutional capital before. We have not done that. We have backed people who are spinning out of a fund and starting something new. We've backed people where there's, call it 2 or 3 GPs, and only one of them has the longer institutional track record, and maybe the others only have angel, and maybe some have like the operating strength. But we haven't done I've never invested anybody else's capital but my own. And we can talk about this, but it's harder for institutional funds to do that. And I know you had Graham from Sandana on your podcast before.
Yeah, absolutely.
Right. And this is one of the reasons why I there should be more Sandanas in the world, right? Because there need to be more people like Lotonia Plexo, right? I'll sing all their praises because people that will help somebody institutionalize for the first time is meaningful. And we like partnering with them on funds because it's not that we think there's a lot of opportunity there. It just demands a slightly different go to market by the LP. And you want to make sure that you're prepared to do that. Otherwise, I think you leave your GPs hanging. So it's a bit of us thinking through how does it go to market? And you're seeing like what you were talking about with Thunder and some of these other ways of matching people, and then operator and recast, these ways of also helping some of the newer managers think through institutionalizing.
Absolutely. Okay. So you talked about return history. I think we knew that was the main thing to look for. How about what other factors that are a little softer underbelly of a selection process? Maybe strategy or...
Well, we follow the same process for everybody, which is getting to know you through your investment world, because that's who you are from an investing standpoint. Like if I took away Mark and I just looked at Interplay, I would hopefully be able to get a sense of what you like and what you do and which entrepreneurs you're picking and who picks you. And that's the simplest way I say it is the why you question, which is why are you doing this fund? Why are you going after this market? And why do you think you're going to win? And then if there are people that you've invested in that we can talk to understand the role that you play, that's basically what we do. And
that makes total sense.
The blocking and tackling looks like quantitative analysis, references, and understanding the market. We try to spend a lot of time understanding the market. So when someone tells me what their strategy is, it can resonate. I think it's a lot harder if you don't. Like we're pretty focused on venture. And it helps then because things, you can hear stories and they make sense.
Right, because you'll know it works.
Way. You know that it works. And even we back some strategies that, to your point of like, does it always look the same? It just doesn't always have to. And right now, what I think is just so fascinating is the distribution of ways funds are happening. Like venture is both becoming incredibly concentrated in big funds, like the rise of the mega funds and all the fundraising last year and this year clearly is getting hoovered up by a lot of big funds. But at the same time, the new end of venture is being really distributed amongst scouts and angels and syndicate structures. And I don't have a count. We're just not equipped to count it. The number of smaller 5 to 10, $15 million funds, operators getting involved. That's super distributed.
Right. And Angel List is putting all that on steroids.
Yeah. Which is so interesting to see how all that's going to play out. I mean, I definitely hear of traditional seed funds getting crowded out because of those newer entrants into rounds.
A little side note here. I was talking to one of our LPs recently who was asking me for trends. One of the reasons he invests is market insight.
Yep.
And I said, one of the most fascinating things I'm seeing happening is the full depth of institutionalization of capital for the entrepreneur. When I started in this business in 06, it was the Series A was the first round. Mm-hmm. And friends and family was everything before that. And then the seed came out. And to see pre-seed as a category is so exciting for me because I believe it's going to take thousands more entrepreneurs who don't have a rich uncle to write that first check and put them in play.
Yep.
I think that talk about democratizing, one of the things we want to do with Thunder, I think it democratizes the playing field in a really productive way to get more people with good ideas, regardless of background, into the game, getting training, and maybe building something awesome.
Yep. And we're seeing, I don't have a front row seat to this. I always joke around and be like, the LPs are like the peanut gallery in the back row of this baseball field watching them. But we're seeing syndicates come together of operators so that let's say you're starting a company, you can get money from people who are doing it at the angel level who individually may only have a couple $1,000s, right? But collectively can support you. And that's super interesting and cool and democratizing. And that 0 to 1 is so hard, right?
Right. What happens in the world if everyone's an innovator, or at least a huge chunk of people? Good things, I think.
Good things, right?
Yeah.
I think also when I look at the world and my son's like, Mom, why are you guys all destroying the world? Don't you know climate change is an issue? I'm like, but wait, there's smart people fixing it.
Right. We're hopeful.
We're hopeful.
Okay, so there's two other dimensions that come up a fair bit for folks who have ever raised capital. One, it's around the team, obviously. And one of the heuristics I hear that a lot of LPs are focused on is the time the team has worked together, usually as a signal for the durability of the strength of the relationship, and the access to co-investments. Where do you guys register on those two dimensions?
I'll own all my biases. It's lovely to see people who have worked together because what you're reading for is the obvious, like, can they work together? And money is a funky product. Let's like be open door about it. Like the LP's product is money. The GP's product is money. GPs are trying to make money, which is good. You want an economically motivated investor. But it can bring in a lot of tensions. And so how does all that interplay? And do they agree on deals? Do they not agree? Right? And how do they make decisions? Like all those things, this is why LPs default to how long have you worked together? Because it's just an easy way of saying, have you figured out a way of working through all this stuff and celebrating the successes? And has somebody had so much success they don't want to do it anymore? Like all that stuff. It's just a quick, easy way. That said, I don't think it's any guarantee. I know many funds where people are not happy working together, but they're making so much money working together that they can't break up. I don't know. And
Would you invest in that? The dysfunctional marriage where everyone's kind of locked in? Would you?
I want to say maybe, to be honest, because I think it happens more often than people want to talk about. Because certainly after funds versus people leave funds, you hear a lot more of the broken glass than during. So I don't think it didn't exist.
Right.
And just because it's this weird world in venture, just because people aren't always happy doesn't mean they're not going to make some great investments. And sometimes the discord about different opinions leads to a good decision. But there's also some level, which what I think you're getting at is, which if it's so dysfunctional internally and that it's a difficult partnership and you don't think it's going to be productive, then no. And sometimes, honestly, I think this is why LPs have struggled with the two-dimensional Zoom world. There are a lot of experiences you have being in the same room with people at annual meetings, at pitch sessions. And Zoom really takes a lot of that out of the table just because it's 2D. And I think that's really been tricky for LPs because we've certainly been in pitch sessions where there's odd dynamics. And you're like, oh, this is so weird. Are they getting along? Are they not getting along while they're pitching us? This is kind of, what is going to do with that?
Save it till you leave, right? At the very least, act for an hour. I mean, come on.
Well, yes, but I'm sure it's similar when entrepreneurs come in to pitch the business. I don't think any of this is any different. Right?
It's the same. It's the same. I have a good friend who started a fund a couple years ago, to remain nameless, And he and his partner invest two totally different ways.
Yep.
One's not right, one's not wrong. They just look for completely different styles in how they decide to write checks. It was so dysfunctional, they just cut the capital in half and said, you do half and I'll do half. That's unfathomable. And so I think for folks out there who are listening, who are considering the LP path as a high net worth or otherwise, these are real considerations just to understand the culture and the dynamic of the folks involved.
Yep. And then you had asked about co-investments.
Yeah,
do you want to go there?
Yeah, let's do it.
It's always been there, right? Back in our DFJ days, right? Like it was there during that era. I think let me see if you had the same experience. I think it's on steroids now, as far as LPs saying they want to do co-invest. What I don't know, because unfortunately SPVs are completely non-transparent and no one collects the information. So sadly, no guts. I don't know how many folks really do. I mean, some folks are structured to do it. And some endowments and foundations are structured to do it. But for a lot of other folks, if you're not, it's hard to make a direct investment decision when it's not your bread and butter. And some
Very
people,
true.
Right? And some LPs come up with rubrics. Yeah, right? And some LPs come up with rubrics, which is whatever it is. Mark has conviction and the lead is a lead investor defined in a top tier based on whatever. It was one of these 18 funds.
Right.
Will do it. And then other people, and you tell me this is true, say they want to do it and then don't. And that can be frustrating for the GP.
It's a weird signal. So when we raised our last fund, not all, but some of the larger pockets really wanted to know if there's a co-invest option. And we do have one. And we see a lot of activity that doesn't fit our very narrow thesis for the fund. We have a very specific way we invest. And so when something's outside of that, they're a little too early, a little too late, or they don't meet one of our heuristics, and we love the deal, well, our partnership wants to write a check individually. But we don't do that really without showing it to the LPs who are invested in our fund. And so what we found pretty quickly is vast majority of the deals we do are through the fund. But these one-offs, which don't happen that infrequently, maybe every other month, we'll have an SPV that will come up. And what was interesting was we caught a lot of the LPs off guard because they had earmarked a certain amount of dollars to our fund, and suddenly they realized they were going to make a lot of money if they invested in everything we did. And that wasn't what they had budgeted for. And so we told them there was going to be co-investment, but they just didn't, I think it just didn't register. They said they're in for X dollars. And now if they want to put 2X or 3X to work, they can. And it'll be a fantastic portfolio. So my coaching to folks, because we've had a lot of people shocked by this. And so LPs will say, hey, I'm just going to invest in the fund. I don't know what to do with the rest. Okay. Other folks are saying, well, is this the good one, the good SPV? And I tell them, we don't do an SPV unless we think it's awesome. So I recommend they think about it programmatically. This has been my advice to folks. Mm-hmm. But earmark an amount of money for SPVs outside of your LP commitment. And it could be zero if you don't have budget for it, but it could be as much as you want it to be. And divide it by the number of SPVs I think we're going to do a year. So I give them an estimate, and they just become automatic checks. Otherwise, they're paying us to make venture decisions, but then are playing VC once it comes to them. It's just not their expertise. They're real estate wizards or credit wizards or anything. So it's a challenging situation, I think, for LPs to do the co-invest, but it's fantastic because they got a relationship with someone they trust, and they can see deals that we think are so exceptional we have to chase. Well, and usually that comes across.
Thank you on behalf of your LPs for actually thinking through how many you might do per year. I've never had anyone tell me that because it's just so hard to know. And I don't think they think that same way.
Well, we think about our business, and maybe we're going a little off topic here, just we're going to go with it, as a company, not a bank. We think about the operational throughput, our KPIs around number of deals. This must be stuff, I mean, you're looking at your business that way. You're thinking about how many dollars are going out, how many dollars are coming in. You must be looking to your GPs to be thinking about, okay, how many deals do they do a year? When are they going to be fully deployed? Right? You have to be able to project out some operational KPIs to function.
Yes, but when you're speaking, so one of the reasons why we structure our business in the beginning to think through with working with people that manage institutional capital is exactly things like this, where that's just, no one tells you that when you start a fund. Right? When you're starting right? Like this is, I mean, now maybe there's some programs for it, but in the beginning, in the old days, no. It was about like, I'm going to go get great deals. And you're like, yes, but you are running a firm. And those are the attributes which are not always as wildly, sexy and interesting. And it's not the same thing as saying I was like an investor in Coinbase or Uber or pick your favorite company. It's more like, it's exactly this. Like, what's my pacing going to be? What happens when, reserves are tricky. I mean, figuring out your reserves, like you don't know what the rounds are going to look like. And then do you leave a whole half your fund for reserves and then pick it as basis companies come, or do you reserve per company? Both can work, both cannot work. How and when do you recycle? Which again, these sound like very boring, tedious things, but can be the difference between significant return multiples on a fund.
Completely agree.
Right.
What's the right reserve thinking for the GPs listening out there to pick your brain? You've probably seen a lot of different strategies. What do you like?
Well, this is where I think multiple strategies can work. We're seeing a lot of people now in the first funds that are small, reserves are not always possible. And then it's a bit about getting your ownership when you can get it and holding on. And, you buy as much as you can in the beginning because you'd rather use your money that way. But then your reserves kind of vary depending on how much you think you're going to play at the A and the B. And what does that valuation mean vis-a-vis your fund size? And I don't think there's a simple answer, I guess, is the challenge, because it really depends on what kind of investor you want to be. We have some investors who are like, I'm going as far big as I can on ownership in the day one. And then I'll keep going, but it's not as big a deal. I have other folks and everyone can be successful. So it just depends on how you play the different parts together. Are like, no, we're going to put a toehold in and then we're going to try to fit money in between rounds. And there's different strategies for doing that. I had one investor who's very successful, who's like, listen, I figure out what 1% costs me in that company. And then I just do the math on, is this 1% going to make me more money than something else? And I was like, that works too. It's the beauty of venture. There is not one size fits all. There are just different components that always come into play in your portfolio construction and the size of your fund and your ownership and your checks, and then the size of your exits, all just different toggles that you have to be conscious of.
Right. It's like one formula. And if you're going to move this lever down, you have to move something else up. Okay. How about sectors? I argued with Ian Sigalo about this on the podcast.
Ooh.
Do you know Ian?
Yeah.
At Greycroft? He's great.
He's smart. Yeah.
Yeah. I said, this is the smartest person I'm ever going to interview. I had to get ready for him. I've known him for a long time. And so I said to Ian, tell me your sectors. And he rattled off some fantastic sounding sectors. And I said, is there a company in tech that if it's performing well will not fit into one of those sectors? And the answer is, I feel like most VCs are concocting sector concepts, sometimes with creative names, sometimes without, that basically cover everything. So they can get it. They're going to do the good deals, more or less. And they want to put my numbers up. That's what matters most. So what's the right answer for sectors? Because I want to invest in good companies. And that's not the popular answer in a fundraise with LPs.
Yeah. Well, as one of my wise GPs said to me, they said, Beezer, there's one way I talk about my world to the LPs, and there's another way I talk about my world to the entrepreneurs. And it's not that the information is any different. It just needs to be packaged differently.
Right.
And I was like, true that. It goes a little bit to what you were saying about when an LP is like, oh, but you're my seed fund, so please stay in seed.
Yeah.
LPs may or may not have a view on sectors, and therefore will try to solve for different things. And there should be some alignment between why would you be able to pick a great company that's out of your field of experience, which I think sector is just a loose, maybe potentially lazy way of looking at it. That.
Yeah.
We haven't been, I think what I have found, the way I think about it now is this market is so competitive. If you can find an area that's not competitive, like good on you, but it's so competitive in so many places, you need to have a reason to be on the cap table more than ever. I don't think that was ever untrue. But back when there was 10 VCs on Sand Hill Road and it was a really ivory tower world, maybe a little bit less. So having money was the reason to be on a cap table. But that's this market has plenty of money. Doesn't all get fairly distributed. There's lots of entrepreneurs I know who are sitting here like, well, if there's so much money, why is it still so damn hard to raise? And that are other reasons we can talk about. But I think the reason you need to be on a cap table and what's your perspective. So for us, it's much more interesting to hear. It might be it might come out in a sector. Like we have some very enterprise focused investors, and it's because they have a perspective on that sector. It's not just because they're telling me it's enterprise. Like, well, that's fine. If you're picking enterprise for enterprise sake, it's the right sector for them because they have a perspective on it. Or we do have some thematic investors who are passing on huge chunks of the industry because it doesn't fit their theme. And so it's not going to get they would never have had Snowflake in their portfolio. Which is a bummer because it'd be nice if they had Snowflake in their portfolio.
Right.
but it's not the theme they're doing. They're doing something else. They're doing consumer. They're doing a version of consumer. They're doing something else, and it's just not their thing.
So how do you feel about these specialty, let's call the edge case funds or specialty funds? Things that have, firms that have, I'm thinking about the edge cases, specialty funds being one of them. You get emerging managers, solo GPs, specialty funds. Let's start there. How do you think about the role they play in a portfolio, your interest in them, et cetera?
So I don't think we think about it any differently. The specialty has to be something that we think has legs. And it's sort of a question of like, how niche-y is the specialty? And sometimes if it's super niche-y, maybe it needs to be a really small fund. Or it just sounds like it's niche-y, and the reality is it's not, it's ginormous. And people just haven't thought, like way back in the day when we launched Sapphire Partners, we had a thesis around big data. Mm-hmm. And that was niche-y back then, which is a ludicrous thing to say. It's ludicrous. But this is also part of the heritage of being able to play with a large software company that was RLP that was trying to figure out big data. So it just informed our viewpoint. But we've had multiple funds go after what now is big data, which is like just, and they can take it everywhere, biotech, media, like it's everywhere.
That's now a sector that matches what I was saying before, where kind of applies almost everywhere.
And then there's some which are
still
for a moment
it wasn't.
But for a moment it wasn't. And there's some like, I'm going to pick on aerospace because we have not yet backed an aerospace dedicated fund because I don't know. And back in the day, fintech was niche-y.
Right. It changes, that's for sure.
It changes. So usually we try to, again, we just kind of go into what's your perspective, and is it an inch deep but really wide? Like we have generalist solo GP funds, but they have something about how they pick an entrepreneur that works, and that's really where their perspective is. But it can come into any area. And then we have other ones who are like this enterprise solo GP who's got a particular perspective on Jamstack, which sounds really niche-y, but it's building on top of all this other stuff. And the fund's small and it's focused. So, but
you don't worry about key man risk or cultural dynamics. Yeah,
we used to. But to the conversation about the GPs not getting along internally,
there's that too.
And that's harder to see. Like we used to not do single GPs, and then I can't remember what got us over the hump. Something got us over the hump, and then we're like, oh, it's actually a much easier key man risk. Like we don't hope anyone gets hurt or stops doing their work for whatever reason. But if it's just you, Mark, doing investing, or just me, if it's happening. Whereas when there's multiple people, you're not really quite sure because it's a team, and that's the beauty of a team. But it's also the opacity.
Yeah,
whatever that
both
word
work.
is.
Yeah, both work. Everything works here.
But I know lots of LPs that get stymied by the solo GP, and sometimes it's also how much money can one person manage. And how many companies can one person manage? And those are very fair questions, which a lot of solo GPs, because LPs are thinking, I want to be with you fund 1, 2, 3, 4, 5, 6, 7. Like the goal is to be with you for a long time, probably longer that you want to be in venture. And how many portfolio companies are they? And how quickly will they exit? And at what point, can the work that you do work with that structure and all these things, right?
Does it scale operationally?
It doesn't scale operationally. Yeah. We're seeing some novel strategies getting at it, but I think those are the sort of stereotypical concerns that LPs have, and much more the institutional LPs, right? Because they're probably trying to write bigger checks. I think the high net worths and folks that might be more comfortable with it.
That makes total sense. Well, there's a pattern in my side of the house. The most attractive deals are the most competitive, right?
Go figure.
Yep. And there's often 3 to 5 times more capital chasing them. And the game for us is to cut the line and get in. The dynamic probably applies for you too. Mm-hmm. Right. So what happens, when you guys think about finding a manager that is real popular in your community for whatever reason, what's the pitch for you guys getting into the deal? This is the moment where I'm going to give you an underhand pitch and say, what's the reason someone should take Sapphire Partners money?
Well, when we built the firm, we were trying to answer that question. So you can tell me if you think it's answered, but we want to be the LP. If you're going to have somebody you're going to call with your hard questions, that's the role that we want to play. We're dedicated to venture. We've got permanent long-term capital. We understand the market. So when you have a question, we can be there. We don't need to be there every day. I don't think LPs should be hanging out every day with their GPs. As lovely as it would be from an LP, the GP has other stuff to do. But when you were saying, I'm in the forest, what's going on with the trees? Like that's when LPs should be there for you. And I think that's where we just constructed our business to play that role. we're not going to play the role of saying like, well, we're going to do private equity and we're going to do publics and we're going to do all those things and we're going to try to write $100 million check into you. Like, that's not our role. There's other LPs that play that role. We are going to be the thoughtful, dedicated, permanent, all-in person. And I think the other thing is, I think our check size is relatively friendly, because what we want to do is be able to collaborate with other LPs so that the GP can choose but not have to get crowded out. There's some LPs that try to put, they do need to put $100 million to work into a fund. And that also challenges them on which they can't do the smaller funds. And we would like to be able to flex. So we work with them. We try to construct a world where we could do all those things. And when we were constructing our vehicle, it was not lost on us that most funds are not actually investing over 3 to 4 years. Funds get raised every 2 years, sometimes faster, sometimes a little bit slower. And so we constructed our thinking in advance, saying we know this is true, so let's not be surprised by it.
I think your permanent capital story is a big differentiator. On the being the advisor to the GPs, part of it I hear from you is being focused on the sector, on the space, the stage, more or less. But how do you make sure you have enough time? Are you guys limiting funds per partner? It sounds like you're pretty concentrated. Is that part of the narrative with us?
I think part of it, I think it's certainly a component. And some GPs are like, we'll catch you at the annual meeting and we'll like have lunch every 6 months. And it doesn't say like, you can be thoughtful and engaged and productive. This is why we do a lot of the thought leadership that we do. So we do work on our side and then share it. My colleague Laura and Hillary wrote this great blog on recycling. And like,
that's fantastic.
No GP was like, it spawned a lot of awesome conversations, not just with emerging managers. Like, recycling is hard and it's hard to know. And so we work with our established on it too. But we didn't, to your point about how are you there? Like, we try to think through questions people are going to have in advance and produce the information. And if it's useful for them, that's great. And if they don't want to read it, like, no harm, no foul. Right.
On that note, can you tell us about OpenLP?
Yeah. So we started this with a couple other LPs, I want to say 6-7 years ago now. But again, my frames of time are getting muddied. And it was, as you said, what we looked around the world, and I was actually having lunch with Chris Duvos. I don't know if you know Chris Duvos of Super LP, Ahoy Capital. And he was like, hey, don't you think all these GPs that ask us these questions would want to know what LPs are thinking? And I was like, yes. And there's nowhere to go. Right. And it wasn't so, and then we just took it and we just were like, well, let's make it big, because you can see in the GP to entrepreneur world how much information is available and all the blogging and the podcasting and all the stuff. And there is so much less between LPs and GPs or even entrepreneurs that want to participate. So we created a platform that really just aggregates and amplifies. The point is to support everybody. It's not just my voice. It's not just your voice. It's an aggregator and amplifier. So we can take up whatever content we can find and put it both. We have a hashtag. We have a website, and create this and not just democratize information, but also like help explain the business a bit, because it's way more opaque than it needs to be. And it's just so clear that this is what works, and given the entrepreneur response to when GPs do this. So it was a bit of a no-brainer, but it goes to your point of, well, why did we do it? Because we saw the need and we could. And this is part of what just makes us a different LP, because we're not running, endowments are a business for a school or a hospital. We're not doing that. Like, I don't have to go meet a board and talk about how I'm going to go fund a building. I can spend my time doing this. And we just deployed that time that people don't see all the other work that LPs have to do. We're not fundraising. I'm not hitting the road trying to raise. Like, so we take that time and we try to be in service of our community by doing these things.
That's wonderful. I'm going to draw a parallel and then ask a question.
Okay.
So, long time ago, back when we were actually at the same firm back at DFJ, I started blogging. And my mission as an entrepreneur who felt like he was undercover in the venture world was to expose the process for raising venture capital. So I was writing 3 posts a day for 5 years. And I wrote a table of contents, and it was a chronological handbook for entrepreneurs to raise venture. Eventually, I had a gentleman come in, and just for a meet and greet, who was a best-selling author. And he sat me down and he said, are you planning on making a book? And I said, no, I don't believe in paper. He said, can I be frank with you? Are you fucking kidding? So 2 years later, after people asking for the book version, I made a book. I turned that content into a book, and it's out there. It's called The Fundraising Rules. Is OpenLP going to become a book?
I cannot believe you just asked me that question. It's so awesome. Wait for an announcement. It's not a book, but there will be something coming out very soon that we can help pull things. I can't say more. Our head of marketing will kill me, but yes, I'll let you know.
Okay, great. Great. When that comes out, let us know. We'll tag it in the show notes.
Okay. Awesome.
This was great. We used up an hour already. We didn't cover everything I wanted to cover, but this was so rich in content. I think we're going to cut it here. Anything else? Let me ask you one question before we leave off. I usually do this with the entrepreneurs. What's the most important insight, bit of wisdom you'd want to give to the GPs out there? Thing to just do better or watch out. What is that?
I always ask this of our GPs, like, are you enjoying it? Because it is a long road. It looks sexy and like glamorous from the outside, and there's days that there are, but it is a long road. If you got to do a job for 8 or 10 years before you make your carry, and that's like the first check. That's not even like all the checks, right? I just think it's so important to be, I have no actual scientific data to support this. I think in some respect, if you don't love what you do on this, some aspect of it, I think that feeds the great performers. And I haven't like climbed around Sequoia to see how this works or not, but there just has to be that. And if you're miserable, it's not a good role, and go find something else to do. Right.
GPs will say it's a great way to get rich slowly.
Oh, and then wait for the LP side of it.
Oh, I'm sure. Hey, thank you for being on today. It was fantastic having you. We're grateful. Thanks for making time.
Thank you for having me.
That was solid. Beezer is super sharp, as you guys just heard. Big thank you for her coming on the pod and sharing some of her wisdom. I think there's a ton of great info in there for GPs and aspiring LPs. If you liked what you heard, please hook us up with a like or a 5-star review, and feel free to share with a friend. You can find me on Twitter @MPD, and to hear more of my conversations with innovators, subscribe on YouTube, Facebook, or any major podcast platform. Just search for Innovation with Mark Peter Davis.